A business cycle is the pattern of expansion boom and contraction bust that an economy experiences over time. Think of it as a roller coaster ride. The track goes up expansion, reaches a peak, comes down recession, and then flattens before climbing again trough to expansion. Phases. Expansion, GDP, employment, and income rise. Consumer confidence is high and firms invest more. Peak growth hits its maximum, inflationary pressures often start to build. Contraction, recession, output falls, unemployment rises, and confidence wanes. Trough, the low point where the economy stops shrinking and prepares to grow again. Duration varies widely. In the United States after World War II, expansions have averaged about 5 to 7 years, while recessions have lasted roughly 1 to 2 years. The length depends on the size of shocks. For example, oil price spikes, financial crises, and the policy response. The key takeaway for MBA students is that cycles are not regular like a clock. They are irregular, driven by real shocks and policy actions. The D-S model captures the whole economy relationship between the total demand for goods and services D and the total supply S. Aggregate demand Ds. Y equals C of Y minus T plus I of R plus G plus Nx of E. Where Y is real output, C is consumption depends on disposable income Y minus T, I is investment downward sloping in the real interest rate R, G is government spending, and Nx is net exports function of the real exchange rate E. Short-run aggregate supply SRAS. P equals PE plus beta times Y minus Y star. Prices rise when output deviates from the natural level Y star. Long-run aggregate supply LRS. Y equals Y star. A vertical line at Y equals Y star, the economy's potential output. Boom, a positive demand shock, for example, a fiscal stimulus shifts a D rightward. In the short run, the new equilibrium is at higher Y and higher P, inflation. If the shock is strong, the economy may overshoot Y star and create upward pressure on wages, eventually shifting SRAS left and moving the economy back to Y star with higher price level, the classic boom-bust story. Recession, a negative demand shock, for example a fall in consumer confidence shifts a D left. Output falls below Y star and price pressure eases. SRAS may shift right as input costs fall, helping the economy return to potential. The D-S picture is a useful visual for MBA students to see how policy changing G or taxes or external shocks oil price, exchange rates move the economy's equilibrium. Equilibrium shift analysis example. Y equals 200 plus 0.8 of Y minus T plus 150 minus 10R. LRAS equals 600. A fiscal expansion of delta G equals plus 50 moves a D to Y prime equals 250 plus 0.8 of Y prime minus T plus 150 minus 10R. Solving gives a higher equilibrium Y approximately 650, and because LRAS is vertical at 600, the gap creates inflationary pressure. Explanation. The Keynesian multiplier tells us how much total output changes when an autonomous component of spending government purchases investment or exports changes. The formula is K equals 1 divided by 1 minus MPC, where MPC is the marginal propensity to consume, the fraction of an extra dollar of income that households spend. Intuition, a $1 increase in G gives $1 to some people. They spend a part MPC of it, giving MPC of it to others. They spend a part of that, and so on, a geometric series that adds up to the multiplier. Assume MPC equals 0.8, so MPS equals 0.2. The government decides to cut taxes by delta T equals minus $100 billion. The tax cut works like an increase in autonomous spending because households have more disposable income. The direct increase in disposable income is $100 billion. The induced increase in consumption is MPC times delta T equals 0.8 times 100 equals $80 billion. The total change in output is delta Y equals 1 divided by 1 minus 0.8 times 80 equals 5 times 80 equals $400 billion. Thus, a $100 billion tax cut generates a $400 billion rise in GDP, a multiplier of 5. Policy implication for MBA students. When the economy is far below potential, fiscal expansion can have a large impact because unused resources, idle factories, unemployed workers allow the multiplier to operate near its theoretical size. In a tight economy, the multiplier shrinks because rising capacity constraints raise prices rather than output. Explanation: the ISLM model shows how the goods market IS curve and the money market LM curve interact to determine output Y and the interest rate. It is a handy algebraic tool for visualizing monetary policy. IS curve goods market equilibrium. Y equals C of Y minus T plus I of R plus G. C equals C0 plus C1 times Y minus T. I equals I0 minus I1 times R. Plugging in gives Y equals C0 plus C1 times Y minus T plus I0 minus I1 times R plus G. Rearrange to express R as a function of Y. R equals C0 plus I0 plus G minus open parenthesis 1 minus C1 close parenthesis times Y plus C1 times T all over I1. LM curve money market equilibriums. M over P equals L of Y and R. Use a simple linear money demand function. L equals K0 plus K1 times Y minus K2 times R. Set real money supply M over P equal to L and solve for R. R equals K0 plus K1 times Y minus M over P all over K2. Interest rate policy. When the central bank increases the money supply, M up, the LM curve shifts rightward, lower R for any Y in the ISLM diagram. This moves the equilibrium to a higher Y and lower R, a monetary stimulus. Example with numbers. Take C0 equals 50, C1 equals 0.6, I0 equals 40, I1 equals 20, G equals 100, T equals 80. Money side, K0 equals 30, K1 equals 0.5, K2 equals 15, M over P equals 200. IS equation solved for R. R equals open parenthesis 50 plus 40 plus 100 minus 0.4 Y plus 48 close parenthesis divided by 20 equals open parenthesis 238 minus 0.4 Y close parenthesis divided by 20. LM equation. R equals open parenthesis 30 plus 0.5 Y minus 200 close parenthesis divided by 15 equals open parenthesis negative 170 plus 0.5 Y close parenthesis divided by 15. Set them equal to find equilibrium Y. Open parenthesis 238 minus 0.4 Y close parenthesis divided by 20 equals open parenthesis negative 170 plus 0.5 Y close parenthesis divided by 15. Cross multiply and solve gives Y approximately 520 and R approximately 2.5%. If the Fed raises M over P to 250, the LM equation becomes R equals open parenthesis negative 120 plus 0.5 Y close parenthesis divided by 15. Solving again gives Y approximately 560 and a lower R approximately 2.0%. The model shows how a monetary expansion lifts output and reduces the interest rate, a core concept for MBA finance courses. Real business cycle theory treats fluctuations as the efficient response of the economy to real shocks, mainly technology changes. The core idea: households maximize utility, firms maximize profits, and there is no sticky price, therefore all changes in output are rational. Solow residual total factor productivity, A, is computed by rearranging the Cobb-Douglas production function. Y equals A times K to the alpha times L to the 1 minus alpha. Solving for A gives the RBC productivity shock measure. A equals Y divided by K to the alpha times L to the 1 minus alpha. Take logs to estimate A over time. ln T equals ln YT minus alpha ln KT minus 1 minus alpha ln LT. Numerical illustration: suppose in year T, we observe real GDP YT equals $1,200 billion capital stock. KT equals 2,000 labor hours. LT equals 800 capital share. Alpha equals 0.35. Compute ln a T equals ln 1,200 minus 0.35 ln 2,000 minus 0.65 ln 800. Numerically, ln 1,200 is approximately 7.09. ln 2,000 is approximately 7.60 times 0.35 is approximately 2.66. ln 800 is approximately 6.68 times 0.65 is approximately 4.34. Thus, ln a t is approximately 7.09 minus 2.66 minus 4.34 equals 0.09. So a t is approximately e to the 0.09, which is about 1.094. A value above 1 signals a positive productivity shock, about 9.4% higher than the baseline. RBC theory would argue that this shock explains the observed rise in output, not fiscal stimulus. Takeaway for MBA students: the Solow residual isolates the part of growth that cannot be explained by capital or labor, a key metric when evaluating whether a boom is driven by real improvements technology or by demand-side policies. The Phillips curve captures the empirical trade-off between inflation, pi, and unemployment, U in its expectations augmented form. Pi sub t equals pi sub t minus 1 minus beta times open parenthesis u sub t minus u sub n close parenthesis plus epsilon sub t, where pi sub t minus 1 is last period's inflation, which represents inflation expectations when agents are adaptive. U sub n is the natural rate of unemployment, the level consistent with stable inflation. Beta greater than 0 measures how strongly unemployment gaps affect inflation. Epsilon sub t is a supply shock term, for example, an oil price shock. Regression-based example. Suppose we have quarterly data for the United States and estimate pi hat sub t equals 0.02 plus 0.7 pi sub t minus 1 minus 0.5 times open parenthesis u sub t minus 0.05 close parenthesis. Interpretation. The coefficient 0.7 on lagged inflation shows persistence, meaning inflation tends to continue. The coefficient negative 0.5 means that a 1 percentage point rise in unemployment above the natural rate reduces inflation by 0.5 percentage points. Scenario: the Federal Reserve tightens policy, unemployment climbs from 5% to 7%, a 2-point gap. Expected change in inflation. Delta pi equals negative 0.5 times open parenthesis 0.07 minus 0.05 close parenthesis equals negative 0.01, so inflation falls by 1 percentage point. Implication for MBA. When the economy is overheating, low unemployment, inflation pressures rise. When the economy is in recession, high unemployment, inflation eases. Policymakers use this relationship to decide how aggressive monetary policy should be. However, the curve can flatten if expectations become well anchored, meaning the trade-off weakens, a nuance important for strategic planning and risk management. Economic indicators are statistical series that help policymakers and investors forecast where the business cycle is heading. They are grouped into 3 families. Leading indicators change before the overall economy does. Predictors. Examples are stock market indexes, new order inventories, building permits. Coincident indicators move with the economy current state. Examples are industrial production, employment, personal income. Lagging indicators change after the economy has moved, confirmations. Examples are unemployment rate, consumer price index, interest rate spreads. Construction of an index. A simple composite index can be built by weighting each component. I sub t equals the sum from I equals 1 to n of w sub I times the quantity x sub I comma t minus mu sub I divided by sigma sub I. X sub I comma t is the raw value of indicator I at time t. Mu sub I and sigma sub I are the mean and standard deviation of that series, standardization. W sub I is the assigned weight, weights sum to 1. Example, a leading index with 3 components. Stock market weight 0.4, building permits weight 0.3, and consumer expectations weight 0.3. Assume for month t the standardized values are 1.2, 0.5, and negative 0.2 respectively. I sub lead comma t equals 0.4 times 1.2 plus 0.3 times 0.5 plus 0.3 times negative 0.2 equals 0.48 plus 0.15 minus 0.06 equals 0.57. A positive value suggests the economy is likely to expand soon. If the index turns negative, a downturn may be looming. Interpretation. Rising leading index anticipates higher future GDP growth. Coincident index tracks current GDP growth rate. Lagging index confirms the direction after the fact and helps assess policy effectiveness. For MBA students, constructing a simple index is a practical exercise in data handling and gives a tool for strategic forecasting. For example, planning capacity, hiring, or investment. Automatic stabilizers are built in fiscal mechanisms that dampen fluctuations without new legislative action. The classic examples are progressive income taxes and unemployment benefits. When income falls, tax payments automatically fall, increasing disposable income, and benefit payments rise, providing income support, thus partially offsetting the drop in aggregate demand. Discretionary policy requires an explicit decision, for example, a stimulus bill. To compare their strengths, we use multipliers. Tax revenue multiplier automatic equals negative delta T divided by delta Y. Deficit multiplier, change in budget balance per change in output, equals delta open parentheses G minus T close parentheses divided by delta Y. Sample calculation, assume a simple economy with marginal propensity to consume equals 0.75, which implies marginal propensity to save equals 0.25. Tax function T equals T sub 0 plus T sub 1 times Y, with T sub 1 equals 0.2, 20% of income taxed. Government spending G is fixed at $200 billion. Automatic stabilizer effect. A recession drops output by delta Y equals negative $100 billion. Tax revenue falls by delta T equals T sub 1 times delta Y equals 0.2 times negative 100, which equals negative $20 billion. The budget deficit widens by delta open parentheses G minus T close parentheses equals negative delta T, which equals positive $20 billion. Multipliers. Tax revenue multiplier equals negative open parenthesis negative 20 divided by negative 100 close parenthesis equals negative 0.20. For each $1 drop in Y, tax revenue falls $0.2. Deficit multiplier equals positive 20 divided by negative 100 equals negative 0.20. Deficit rises $0.2 per $1 drop in Y. Discretionary stimulus. Suppose the government adds delta G equals plus $30 billion. The Keynesian multiplier is K equals 1 divided by open parenthesis 1 minus MPC close parentheses, which equals 1 divided by 0.25, which equals 4. The induced change in output is delta Y subdisk equals K times delta G, which equals 4 times 30, which equals $120 billion. The deficit now widens by delta open parentheses G minus T close parentheses equals 30 minus open parenthesis T sub 1 times delta Y subdisk close parenthesis, which equals 30 minus 0.2 times 120, which equals 30 minus 24, which equals $6 billion. Thus, automatic stabilizers already provided a $20 billion deficit increase when the recession hit, while the discretionary boost adds only $6 billion more deficit for a much larger $120 billion output gain. This illustrates why policymakers often prefer automatic stabilizers. They move quickly and with smaller fiscal cost. A credit cycle describes the expansion and contraction of borrowing capacity in the economy. It magnifies business cycle fluctuations through two linked mechanisms. Balance sheet multiplier, the effect of changes in asset values on borrowing capacity. Banks typically lend a multiple of the borrower's equity, leverage. Delta L equals lambda delta A, where L is total loans, A is total asset values, and lambda is the average leverage ratio, for example 4:1. Leverage multiplier, the amplification of output changes through changes in debt-financed investment. Delta I equals theta delta L. Where I is investment, theta converts loan growth into new capital formation. Depends on how much of the loan is spent on productive assets. Quantitative illustration. Assume an economy where initial asset value is 0 equals $1,000 billion. Leverage ratio lambda equals 4. Each $1 of equity supports $4 of loans. Investment conversion factor theta equals 0.6. 60% of new loans become productive capital. Boom phase house prices rise 20%. Delta equals 0.2 times 1,000 equals $200 billion. New loans, delta L equals 4 times 200 equals $800 billion. New investment, delta I equals 0.6 times 800 equals $480 billion. Thus, the economy adds $480 billion of productive investment, a strong amplification of the initial $200 billion asset price gain. Bust phase asset prices fall 15%. Delta A equals minus 0.15 times 1,000 equals minus $150 billion. Loans shrink, delta L equals 4 times minus 150 equals minus $600 billion. Investment falls, delta I equals 0.6 times minus 600 equals minus $360 billion. The negative shock cuts investment by $360 billion, deepening the recession. Key insight for MBA students. The credit cycle can turn a modest change in collateral values into a large swing in borrowing and investment. Understanding the balance sheet multiplier helps explain why financial sector distress, for example, the 2008 housing crash,